The current expectations for the U.S. labor market statistics. Well, we need to analyze this a bit into details. The U.S. job growth slowed down a bit in July and the unemployment rate unexpectedly rose, pointing to a slack in the labor market that could give the Federal Reserve room to keep interest rates low for a while. The most recent statistic showed that it grew to 6.2%. According to the research at our firm, the numbers will stabilize until November, and we will see another surge during the holiday season. Jobs increased about 200,000 last month after surging from the 298,000. The Labor Department had stated that. Many economists had expected 233,000 again, but that didn't take place. Although job growth was below expectations, July marked the sixth straight month unemployment expanded by more than 200,000, which is a signal of strength last seen since 1997. In addition, whatever data we have in May and June that have been revised, 15,000 new jobs were created and more than previously reported. The 1/10 of a percentage point increase in the unemployment rate to 6.2% came about as more people entered the labor market, which was an indication of confidence in job prospects. It is a very good sign to have a report for an economy that is steadily expanding but not lifting off. The Fed will take the data into consideration for the goal of ending what is called the quantitative easing. The U.S. Treasury debt prices also rose as traders trim bets that the Fed would push rates up in the first half of the next year, with the lift-off date predicted by future contracts moving to July from June. Obviously, the report also showed average hourly earnings, which are being monitored as an early warning sign of inflation pressures. That rose only 1%, but left the annual growth rate at 2%, well below levels that would make the Fed nervous and perhaps bite their nails. Some of the research have shown that wages are rising more briskly, that some economists have worried about the central bank could fall behind this curve. In terms of the Fed policymakers on Wednesday, they cautioned that significant labor market slack remain, signaling patience on the rate front. Also that the central bank has kept benchmark rates near zero since December of 2008. All of these are signs that we should be able to read very carefully to make an assessment properly. Thank you.